I've spent most of my life not just building wealth, but studying how it works in the real world. I learned from experience, from trial and error, from books on economics, investing, and human behavior, and from watching what people do when money actually hits their hands. Growing up in Seattle with parents who valued education and hard work, I was curious about what separates people who build lasting security from people who stay stressed forever. From tinkering with computers as a kid to dropping out of Harvard to start Microsoft with Paul Allen in a garage, I have seen how smart choices compound over time. What do the truly wealthy do differently? What do they avoid that most people overlook? After nearly 70 years, after Microsoft grew from a scrappy startup into a global company that changed how the world works, communicates, and innovates, and after watching thousands of people rise financially while thousands more stumble and stay stuck in financial ruts, I noticed something that matters more than any single tactic. It is not only what wealthy people do, though actions like innovating relentlessly matter. It is what they refuse to do. They avoid traps that look harmless but quietly drain fortunes over time. Those traps are like holes in a bucket. You can pour all the money you want into that bucket through hard work, side hustles, breakthroughs in technology, or even lucky breaks. But if it is full of holes, it will never fill. It just leaks drop by drop until all that is left is regret. Most people obsess over making more money, chasing higher salaries, bigger bonuses, or the next big idea. That matters, especially early. Ambition is what drove us at Microsoft when we were a handful of people coding late into the night. But the wealthy put equal attention, often more, on not losing money, on plugging holes, on protecting what they already have. Building wealth is a marathon, not a sprint. Preserving what you have can be harder than acquiring it, especially in a world built to distract you and push short-term thinking. I learned this when Microsoft was young. We had big dreams, but we watched every dollar because one wrong move, like overspending on unnecessary perks, could have sunk us before we even got off the ground. So today I want to lay out 10 brutal mistakes wealthy people avoid. Some of these will sting because you may be doing them. I made mistakes too. I underestimated the competition in mobile operating systems, and Microsoft missed out on dominating Android. That was a $400 billion mistake by my own admission. It taught me not to assume past success guarantees the future. Once you start avoiding these mistakes, your money stops slipping away and starts working for you. It is the same principle behind reinvesting Microsoft's early profits and building something that could keep growing long after the first big wins. First, the rich never confuse income with wealth. People see a fancy car, a big house, and a lifestyle that looks expensive, and they assume the person is rich. Often they are not. I have known people who make $500,000 a year and have nothing saved, zero. They look successful, but their bank accounts are drained by constant upgrades and status symbols. I have also known people who make $60,000 a year and become millionaires because they understand the difference. Income is what flows through your hands. Salary, bonuses, stock options, maybe some extra gigs. Wealth is what you keep and what grows when you are not working. Wealth is assets that produce income without you having to work for it every day. Stocks, real estate, businesses, things that appreciate and compound over time, like Microsoft shares that have grown enormously since our IPO in 1986. Wealthy people focus on being wealthy, not looking wealthy. They build a foundation that lasts through market crashes, economic shifts, and personal changes. Most people do the opposite. They get a raise or a bonus and expand their lifestyle immediately. Bigger house, nicer car, more expensive vacations, designer, everything. And then there is nothing left to invest. They become high income poor, I still wear a simple $10 Casio watch. People think that is quirky, but it is not about being cheap. It is about respecting money and directing it where it can grow or make a difference. Every dollar not spent on flash is a dollar that can compound in investments that matter, including funding work my foundation supports in vaccines and clean energy. When we started Microsoft, we bootstrapped and reinvested instead of pretending we had made it. Second, the rich avoid financing depreciating assets. A depreciating asset loses value the moment you buy it. Cars are the classic example. Drive a new car off the lot and it can lose 10 to 20% immediately. Then it keeps dropping year after year as it wears out and newer models arrive. Yet many people borrow money to buy a car they cannot afford outright, then pay interest on something that is worth less every day. You are paying the bank extra to own something that is actively shrinking. Wealthy people avoid that math. If they buy a car, they buy it with cash they can truly spare, and they focus on reliability and utility. A car is transportation, not an investment, not a status symbol. It is a tool that gets you from point A to point B safely and efficiently. I have driven practical cars for most of my life, including choosing models like a Porsche for reliability rather than pure luxury. And I have seen plenty of very wealthy people driving cars that are 10 years old, not because they cannot buy something newer, but because they understand opportunity cost. The same logic applies to boats, luxury furniture, and high-end electronics that quickly become obsolete. If it will be worth less next year, do not finance it. Ideally, do not buy it unless you truly need it and you have the cash. Monthly payments can make something feel affordable, but interest plus depreciation is a leak that never stops. Third, the rich do not pay retail for anything they do not have to. This is not about being stingy. It is about respecting value. The price you pay determines your return in small purchases and big ones. Overpaying guarantees worse outcomes because you start behind. Most people see a price tag and pay it. They do not compare, negotiate, or wait. They assume it is not worth the hassle. Wealthy people do the opposite. They shop around, they negotiate what they can, they wait for the right price because every saved dollar can be redirected to something productive. When I was building Microsoft, I waited for sales, bought in bulk, looked for deals. People would ask why. My answer was simple. The clothes fit the same and the supplies work the same. Why pay more when the savings can hire another engineer or fund more research and development? That mindset is one reason people stay wealthy. I still wash the dishes at home, partly because it keeps me grounded and partly because small habits are where discipline lives. This matters even more in investing. A great business bought at a terrible price can be a bad investment. I have passed on many deals, wonderful companies with strong potential because the valuation did not make sense for the risk. I would rather own nothing at a fair price than overpay and drag down the portfolio and the work I want to fund. Fourth, the rich never keep long-term money in low-interest savings accounts. You should have savings. You should have an emergency fund, 3 to 6 months of expenses in cash, accessible and safe. When Microsoft was young, I kept a full year of operating expenses in cash. Save like a pessimist, prepare for the worst. But beyond that, earning 1% while inflation runs 3, 4, or 5% is a slow guaranteed loss of purchasing power. The number on your statement may look stable, but what it buys shrinks. The wealthy understand the real risk is not short-term volatility. The real risk is inflation quietly stealing your future options. Many people keep huge piles of cash because it feels safe, but safety is an illusion when inflation is higher than your interest. If cash sits for years, you may have the same number of dollars, but those dollars buy less. That is why the wealthy treat cash as a tool, not a long-term plan. They keep what they need for emergencies and flexibility. then put the rest to work in assets designed to grow. So they keep enough cash for safety, for flexibility, and for quick opportunities, and they invest the rest in productive assets that can outpace inflation over time. Most of my wealth is invested in productive assets, including long-term holdings through Cascade Investment, which focuses on long-term growth in areas like waste management and railroads. That kind of ownership is designed to compound over decades, not impress anyone this weekend. Fifth, the rich never invest in things they do not understand. People break this rule constantly because hype is loud. They hear a tip at a party or see a trend online and throw money in. Early crypto mania, options trading, Forex, complicated derivatives, anything promising quick riches. They invest because they fear missing out. Then when things turn, they lose because they never understood what they owned. They could not evaluate the risk. They were gambling with a nicer label. Wealthy people would rather miss an opportunity than buy something they cannot evaluate. I have passed on investments because I did not understand the mechanics deeply enough. More recently, certain cryptocurrencies felt like bubbles without clear utility. People said I was missing out, but I also avoided losing money by not chasing what I could not explain, including staying clear of the worst of the dot-com frenzy. Avoiding losses matters because losses compound against you just as surely as gains compound for you. Most people also feel like they have to invest in everything because they do not want to miss the next big thing. They want every trend, every hot tip, every app alert. The wealthy do not think that way. They know you do not have to win every game. You only have to win the games you understand. That is why the circle of competence matters. Learn deeply, then commit. Say no to the rest. Even in areas I understand, I assume some bets will fail. In technology and innovation, I can expect a large share of projects to miss the mark. But if I understand the downside and the potential, and I diversify within that knowledge, the winners can matter a lot. That is very different from throwing money at something you cannot explain. The discipline to say pass and to stay inside your circle of competence is not boring. It is protective. It is what keeps the game playable for decades. Six, the rich never try to time the market. People think they can buy the bottom and sell the top by watching headlines and charts. They cannot do it consistently over decades. I cannot do it reliably, even with data and advisors. The pattern is predictable. People sell when fear is loud and buy when excitement is loud, and they end up doing it backwards. Wealthy investors focus on time in the market, not timing the market. They buy good assets at fair prices and hold for years and decades. They accept short-term volatility in exchange for long-term growth, diversifying to manage risk. Through booms, busts, and crises like 2008, the majority of wealth is built by patience. As I wrote in The Road Ahead, we overestimate change in 2 years and underestimate change in 10. Keep the long view. That long view is also why I've diversified beyond Microsoft into areas like nuclear energy through TerraPower. Real change takes time. Wealth building's the same. Seventh, the rich never pay high fees for investment advice that does not add value. Many people pay 1 or 2% of assets every year to advisors, regardless of results. On $1 million, 1% is $10,000 a year, and the compounding cost can become hundreds of thousands over a lifetime. Fees are quiet wealth killers. You do not feel them the way you feel a big loss, but they do damage every year. High fees are not just annoying. They are a drag on compounding. Taking money that could have stayed invested, keeping costs low, is not a detail. It is a strategy. The wealthy keep investment costs low. Many use broad index funds with tiny fees or invest directly where they have knowledge. I have said for years that most people would do well with an S&P 500 index fund. Keep costs low, be patient. Simple often beats complicated, especially after fees and taxes. Eighth, the rich never mix insurance with investment. Whole life and variable annuities are often sold as protection plus investing with tax benefits. But after commissions and fees, they are usually expensive insurance and weak investing. The person who benefits most is often the salesperson who gets a large upfront commission. The wealthy separate functions. They buy term life insurance for pure protection when they need it, cheap and straightforward. And they invest separately in real assets. When I needed coverage early in Microsoft, I bought term. I invested the savings into businesses and long-term holdings, and that compounding helped fund major work, including efforts to eradicate polio. Clarity beats complexity. Ninth, the rich never ignore taxes, but they also never let taxes drive their investment decisions. You should minimize taxes legally using retirement accounts like 401s or IRAs, holding long-term when it makes sense, and using charitable giving strategically. I have done that through large donations, including to the Gates Foundation. But do not buy a bad investment just because it has tax benefits, and do not hold an overvalued asset only because selling would trigger taxes. I have seen people refuse to sell an overvalued stock because they do not want capital gains taxes this year, then watch the stock drop and lose far more than the tax would have been. The wealthy think wealth first and taxes second. If an investment no longer fits, they sell and pay taxes on gains because paying taxes on profit is better than losing the principal. I have paid billions in taxes over my lifetime, billions. And I've even said publicly that if I design the system, ultra wealthy people like me would have about 62% less wealth, around 100 billion less in my case, to make it fairer without crushing entrepreneurship. Taxes are part of the game. They are not the game. 10th, the rich never spend their principal. They spend the income their assets produce. Principal is the base you invested, the seed. Income is dividends, interest, rent, and profits. When you spend principal, you shrink the machine that produces income. It is like killing the goose that lays the golden eggs. You get a meal now, but fewer eggs forever. The wealthy try to live off income and often reinvest part of it to grow principal further. If you have $1 million and earn a conservative 4%, that is $40,000 a year. Live on part, reinvest part, and keep the base intact, and the income can grow over time. Many people spend the whole income and then sell principal for upgrades and lifestyle creep, and over years the base shrinks and so does the income. I have also watched people let lifestyle and ego override this rule. They see principal as a pile of money to spend, especially once they retire. They draw it down and hope it lasts. But markets dip, life lasts longer than expected, or healthcare costs spike, and suddenly the plan breaks. Living off income and protecting the base is not only about getting rich, it is about staying secure. I have never spent my core principal from Microsoft or my long-term investments. My expenses come from dividends, interest, and other income sources. That approach also supports my goal of giving away virtually all of my wealth. I have committed to giving away 99%, and more than $100 billion has already been given in the first 25 years of the Gates Foundation, with the pace accelerating. So those are the 10 mistakes: confusing income with wealth, financing depreciating assets, paying retail without thinking, keeping long-term money in low-interest cash, investing without understanding, trying to time the market, paying high fees for mediocre results, mixing insurance and investing, letting taxes control decisions, spending principal instead of income. None of this requires an MBA. The hard part is discipline and patience. It requires being willing to look different. When others chase status, you choose value. When others chase hype, you choose understanding. When others panic, you choose the long view. Over years and decades, those choices compound into huge differences. I have seen high earners burn through fortunes on lifestyle. I've also seen people with modest incomes avoid these mistakes, invest steadily, stay patient, and end up financially free. The difference was not luck, it was discipline. So look at your financial life honestly. How many of these mistakes are you making right now? Plug the holes. Your friends may not understand why you drive an older car, why you skip the newest gadget, why you negotiate and keep investing simple. That discomfort is temporary. The freedom you build is lasting. Save like a pessimist, invest like an optimist, know when enough is enough, and remember that success is a lousy teacher if it makes you complacent. We all need feedback because that is how we improve. Take action now. Review your finances today. List the mistakes you are making and start fixing them before another day passes. Thank you for listening.